one.
Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. The Talking Point today is what could happen to equities and the impact thereof if indeed the print on inflation in the US turns uglier than what it already is. What impact could it have on interest rates and thereby valuations of not just the US markets but emerging market pack? And juxtapose that with the kind of stance that the Reserve Bank of India has taken, which was arguably very dovish. What would all of this mean for equities? Of course, gelled into the discussion would be the assessment of how the Q3 earnings season has been thus far and what lies in store for 2022. To talk about all of this, Ajay Tyagi, Head of Equity at UTI AMC, joins us. Ajay, great having you. Thanks so much for joining in. It's the first time that we're talking to you. Lovely having you.
Yeah, good morning, Neeraj, and thanks for having me here.
The pleasure is ours. So Ajay, let's start off with the mother market and then move on to the other subsets. The print yesterday, not pretty. Yields are showing their hand already. As we learn, the Fed has called for an emergency meeting in February, though I don't know what's on the agenda, but seems to be that rate hikes would be part and parcel of the near term. What is your view on all of that? And how do you think it impacts the sentiment or the levels of equity markets by and large?
Sure. So you see, we'll have to kind of break it up into parts just to analyze the entire equation. What's the genesis of all of this? It's basically a huge amount of inflation that the world is seeing. Now, there are two camps, one which feels that this inflationary is transitory, and the other camps which feels that this inflation is going to be sticky for some more time because there are supply side constraints, supply cannot be solved within the next few quarters, and hence inflation would remain elevated because demand is strong. Now, the Fed is basically just trying to come in and kind of cool off some demand by both increasing interest rates and tapering off of liquidity. When interest rates increase, now here's the interesting bit. People try and reprice risk. People try and reprice assets. Now, it's fairly straightforward. As interest rates increase, they would have an impact on the present value of various assets because you see, value of an asset is nothing but discounted value of future cash flows. Now, as interest rates or the discount rate increases, these future cash flows would be discounted at a higher interest rate, and therefore they would lead to prices or intrinsic value coming down. Now, if I just go further here, what's happening around the world is that growthy assets, which basically have their cash flows well into the future, and the cash flows which are slightly back-ended, are getting impacted more, and rightfully so. That's the theoretical construct. We've run this across many of our companies across different sectors, and we realize that, let's say, 100 basis point increase in interest rates can lead to somewhere between 10 to 20% diminution in intrinsic value or fair value of different businesses. So that's pretty much the range. And I think markets have already taken that into account. But as you know, and as your viewers should also know, whenever the pendulum swings, it basically goes all the way to the other extreme. So I think right now, this 100 basis point, which ought to be impacting asset prices by 10 to 20%, is impacting these prices beyond 20% because the world seems to be coming to a stop. So that's the theoretical construct. Yeah. So
okay.
Yeah, go ahead.
Okay. Okay. So Ajay, so let me try and then get a perspective. So let's assume that the playbook that you laid out is how it unfolds, and there's a bit of a swinging of the pendulum on the other side in the US markets. How does that impact, or how do you think this time around that will impact Indian markets, particularly in light of the fact that the Reserve Bank of India sounded reasonably dovish, if you will, and if their assessment about inflation in India is correct, then, well, we might actually come out smelling like roses.
Sure. I'll just take the policy that we just heard yesterday in a bit. Let me first go back to the first part of your question, which is that if Fed continues to increase interest rates, we've laid the construct in terms of how much should asset prices be impacted. But Neeraj, equity markets and equity valuation are never so straightforward. I wish life was so simple that there was only one vector and one variable which was guiding the prices. It is never so. I think we have to get a little bit more nuanced here. The first reaction obviously has to be repricing risk, which I think the market has already done in the last 30 to 40 days.
Okay.
But I think from here on, the markets would try to separate men from the boys. And why do I say that? You see, we've always realized as equity analysts that there are two sets of companies that exist everywhere, including India. One, which have a strong pricing power, which have the ability to pass on prices, which have the ability to defend their margins, their market share, and therefore absorb input price increases without impacting their future profitability, future cash flows, and so on. For instance, if there is a company which says that, okay, input prices have increased by 10% for me, if I don't effect the same amount of price increase, my margins would get impacted, and therefore my cash flows would actually come down. It is certainly going to be a lot more negative beyond the 10 to 20% construct that we gave. But if there is a company which says that, look, I can actually take these price increases back to my customers without losing market share, and in the process, on nominal basis, have higher cash flows than what I would have had if, let's say, this inflation was not there, then you are actually seeing the model throwing up a very different number. Then this 10 to 20% construct actually falls down to less than 10%. So I think that's where in the coming months and quarters, the markets will realize that, look, inflation is bad because when it enters your valuation construct, it pushes everything down. But there are a few companies which actually have the power to pass on this inflation, and therefore in the process have higher nominal profits and nominal cash flows, which in some sense cancels out the impact of higher interest rates and discount rate, and therefore it's not all that bad for these companies. So I think that's one point we need to understand. Coming back to the second part of your question on RBI, you see RBI is actually taking it a little more cautiously in terms of not impacting growth as yet, because we are just about coming out of a very bad patch. Two data points that all of us have to understand. Compared to our own history, our CPI print is not all that bad. Compared to the CPI print of US, it is horrendous. We've never seen it in 3 decades. So they ought to be reacting, and they ought to be reacting as of yesterday. That's point number one. Number two, compared to our own growth numbers, our growth numbers are not all that great that they should have been after so much of expansion provided both by the government and the RBI. Compare that to the US situation. Their growth numbers have been absolutely amazing. So therefore, because of these two things, much higher information and therefore much higher, growth rates, and therefore that elbow room, the US Fed can afford to increase interest rates very, very quickly. Their inflation is running out of control, and their growth is still very strong. Now coming to India, the Reserve Bank governor has actually reduced growth estimates for the upcoming year. If you see yesterday, they're talking about now 7.8, which used to be more than 8%. In fact, the economic survey a day before the budget actually talked about 8.2 or 8.3, if I remember correctly. So we are a little tentative about growth, and our inflation is not as if it's out of whack or highest ever in 2 or 3 decades. So that's the bit of a difference that the two central banks are confronted with right now.
Yeah. So and which is why my question, Ajay, what's the impact thereof that could be felt on the Indian equities, considering all of these factors? So let's assume that, like I said, the US does what it does. India doesn't quite need to do it and therefore doesn't do it, but growth does come off a little bit because it is looking patchy, and Q3 is a prime example of that, of how even if the revenue growth is there, profitability growth is probably not in the same vein as revenue growth. And the fact that we are seeing some dichotomy between how rural was 12 months ago versus how rural is right now, even if urban growth is looking okay.
Sure. Let me take the second part of your question first. You're absolutely right. Revenue growth has been strong in the last couple of quarters, whereas margins have really disappointed. But as an analyst over the last 2 decades, the one thing that I've observed is that great businesses with pricing power also don't react immediately because they don't want to really hurt the demand and hurt the customer. So maybe 1 or 2 quarters is just not the right context to visualize whether this high input prices is going to eat into the margins for entire corporate India. I would say it would certainly hurt a big chunk of corporate India, but not the entire corporate India per se. So there would be, and you would see that in the coming quarters, and I can say that with reasonable certainty, you will see many corporates bouncing back to their 2020 kind of margin levels, because they are already effecting price increases over the last few quarters. So not overly worried there, but yes, a word of caution here is, look, when you invest into businesses, be conscious about the fact that not all businesses are equal. Some businesses really possess that ability to defend their margins. While you may not think about margin pressure all the time, but believe you me, such kind of events like black swans appear suddenly. Therefore, it's always better to be prepared beforehand and invest only in those businesses where you know such kind of pressures will be absorbed without impacting the franchise. Coming back to the first part of your question, growth. Yes, we are slightly tentative on growth. At least the central bank, in terms of their estimates, is a little, cautious that they shouldn't disrupt growth. This is what I would say right now. Uh, can growth actually slightly disappoint in the upcoming year? I would put the odds for that as low. And I would simply base that on what we are hearing from corporates, which have their ears closer to the ground and which really get the feedback from their customers, and which really have a better sense of the customer sentiment than possibly you and I as financial analysts have. And I think there the news is quite good. In the most discretionary segments like real estate and automobile, which are the two most high ticket discretionary items of consumption, and on to the other side, which is staples, we haven't really heard about softening of demand or demand sentiment or customer sentiment. Yes, there has been some pocket of weakness, like you rightly called out, in rural India, possibly because of a lot of unseasonal rains in the last 3 months, if you would have observed. We will have to wait and see how that pans out. But on the whole, just listening to what corporates had to say both in quarter 2 and quarter 3, I don't think we are drawing a scenario where demand may actually start softening as yet. So I would still call out that demand may remain strong for the upcoming year, FY23.
Hopefully that happens, and hopefully if commodities cool off and it's a bit of an imponderable, and maybe margins come up even for not the most well-defended margin companies. Ajay, how are you? My final question, therefore, and how are you, therefore, altering your and we don't talk about stocks, by the way, on the show, but how are you altering the themes that you're betting on, considering the various factors? One is what you spoke about, and companies which have maybe defended margins well versus not so well. Two, the belief that if indeed interest rates in the US go up, and the rather that would happen, the change in multiples that happen for some of the tech front companies. Some of the companies are trying to perfection in terms of valuation, and some people say that for IT companies as well now, despite the growth. So how is it that you believe you would want to position the UTI AMC book compared to what it was, say, a year ago?
Sure. I think that's a good question, Neeraj. Let me first try and explain to you the construct at UTI, and then I'll be more specific to your question. You see, here at UTI, we run different funds with different objectives and different styles. And it is certainly not our endeavor to have a house view, which basically means that, okay, in the context of Fed increasing interest rates, why don't we go underweight on tech and why don't we go overweight on, let's say, commodities? That's certainly not the way we want to run our funds, because we do know that different investors and distributors of our funds are looking at style diversity. They are looking at sometimes a value oriented fund, sometimes a growth oriented fund. While we can't change our stance continually depending on what the mood of the market is, but what we've done is that we have everything on display for our end investors. So we do run a high quality, high growth style. We run a GARP strategy. We run a fund which has a value tilt, but it is not pure value. And then finally, we do run a pure value strategy as well. So therefore, it's difficult to answer your question in terms of how is UTI positioning its funds. We want
Just a few
each of our funds to go ahead with their broad construct, with their broad objective, and with their broad philosophy. We always feel that the best position that any strategy can have is the one which does not need to be repositioned every now and then. So, we would run our, for instance, let me just talk about the quality growth strategy. That's the one which has faced the maximum amount of heat of the last 40 days, because obviously growthy stocks are the ones which have been beaten down the most. Are we going to change the script? The answer is absolutely no. Now, this entire thing may take a few months or quarters to play out. We'll have to take it on our chin, but we still have to be extremely pure to that philosophy and continue running the fund as we were doing it, let's say pre-November. But coming specifically to your question, you did mention about things like IT. You see, while risk is being repriced, while growthy sectors like IT and technology and internet is being repriced, but here again, Neeraj, what all of us need to understand and what your viewers need to understand is when men will get separated from the boys in the coming quarters. Not all IT companies are going to fall off the cliff and then just stay there in that abyss. Many IT companies will show strong bounce back if indeed their business models are strong, if indeed their growth is not going to be disrupted by increase in interest rates, and if indeed they have the ability to defend their margins. So I think if our stock selection has been right across many sectors, then we don't need to worry too much. Do remember, companies which are strong in their cash flows also need to worry much less in this rising interest rate environments, because rising interest rate is going to be bad for companies which have debt on the balance sheet. Their financial leverage is actually going to cost them on their margins, which many of these tech companies don't need to worry at all, because they're always hugely immersed in cash. So so that's the long answer to your short question.
No, it was the answer that we were looking for. But Ajay, it was very nice talking to you today. Thank you so much for being with us, and look forward to have you more often on the forum.
Thank you. Pleasure is entirely mine, Neeraj, and looking forward. Thank you.
And viewers, thanks for tuning into this edition of The Talking Point.